Okay, optimistic video here, trying to go through all the different parts of the limited company accounts on one A3 sheet, like the one I've got here, and just trying to talk through share issues, statement of change in equity, statement of cash flows, and the schedule of non-current assets. So I'll go left to right. So share issues, the key thing you're looking at here is the nominal value of a share. That's one of the key bits you need to realize. So quite often can be called par value as well. That is just the minimum that a company will sell shares for. So if you have a standard share issue at the top, so you've issued a certain amount of shares, you increase the bank account because obviously you're going to receive some money from the investors to buy those shares, and then it's going to be broken down into two elements. So the nominal value, the minimum amount, goes into the share capital. So if we sold shares and the nominal value was 50 pence per share, the amount of shares multiplied by 50 pence would go into share capital, and anything we receive over and above that is into the share premium account. So that then reflects how much extra we received over nominal. So within the second year part of the specification, you've got two different types of share issue. You've got a bonus issue and you've got a rights issue. So let's quickly chat through those. A bonus issue is where a company will give free shares to existing shareholders as a reward for ownership. Now, sometimes this can be because a company doesn't have the liquidity or spare cash to pay out in dividends, so they feel that giving free shares might be a way of rewarding shareholders and keeping them happy. Now, we've got to be careful with this because obviously if you're giving away free shares, that can affect the market value of those shares. Be careful, market value doesn't impact the company directly in the short term, but in the longer term, if they try and do a share issue, they will potentially raise less money. And obviously the shareholders themselves won't be too happy with having shares that are worth less money, but they do have more of them. Now, those shareholders can again get a higher amount of dividends in future, but that will depend on if the company is able to pay them, and if they can't now, maybe they can't in the future, but it's still a potential. Be clear though, it doesn't impact control. So we're not going to have any dilution of ownership here, because if all the shareholders got free shares, then their proportion of ownership is exactly the same. Calculation. So the first step, calculate the amount of shares that already exist. So if we've got our share capital amount in pounds, then we can divide that by the nominal value because we've said that's all the share capital section adds up. So we divide the share capital by the nominal value, and that will tell us the amount of shares. We then divide that by the proportion. So they'll quite often tell you that, I don't know, say put here that it's 1 for 4. So that means we'll get 1 free share for every 4 held. So if in that instance, we divide the amount of shares by 4, that will tell us the amount of free shares that have been issued. But that can be 2 for 5, 1 for 6, whatever they want it to be. So just read that carefully. We then measure those because it's got to be in financial value at nominal. So we multiply the amount of shares by that minimum amount per share. We'll firstly increase share capital because we are saying there's more shares in existence, so share capital will go up. And then it's just purely an idea of where we're going to fund that bonus issue from. Now, 99% of the time in an AQA question, that will be share premium. And so we call share premium the least distributable reserve. So what we mean by that is that's the reserve that we cannot use for dividends. So distributable means a reserve we can use to pay dividends, and a share premium we can't. This is the least distributable reserve, so we take it from there first. It also makes sense because clearly a share premium is an idea that our shares are worth more, and if we're giving away freebies, they're not. So we go with share premium first. After that, we could go with revaluation reserve because that's again a non-distributable reserve because it's not a realized gain. And after that, it could be retained earnings. But like I say, the question, it usually just says the least distributable and you go with share premium. But if you've used up share premium, you would have to take it from elsewhere. But yeah, retained earnings, last resort, because that is used to pay dividends. So bonus share issue, so bonus issue, what they'd be looking for in a mark scheme, but increase in share capital, you get marks for that. Decrease in share premiums, you get marks for that, and you'd also get marks for calculating how many shares are in existence, usually. Depends on what they want to do with the mark scheme. Rights issue, slightly different. So this one, we're actually giving existing shareholders the right to buy some more shares. And again, that's proportional to ownership. So I'll say 1 for 4, so it just means you could buy 1 extra share for every 4 you hold. Again, this is a way of rewarding existing shareholders, giving the opportunity to hold more shares, but it's also a cheaper method of issuing shares than a standard share issue. A standard share issue, there's costs involved in setting up in the stock exchange, marketing it, that type of thing, whereas a rights issue, you just contact each of your existing shareholders. So sometimes it's something a company would like to do because it's a cheaper means of issuing shares. Now, It could still lead to a reduction in market value, however, because we've got to incentivize shareholders wanting to buy them. Because if they can just buy your shares on the stock exchange, why would they need to buy in this rights issue? So we tend to offer it at slightly below market rate, and that gives us that incentive as a shareholder to want to buy them. Now, one thing to look at, if they're doing that, that can reduce the market value of shares, the same as a bonus issue. But look for the words fully subscribed. And pretty much all the time it says fully subscribed, but there may be the question where they decide, oh, let's try and trick you and say only a certain percentage of the shareholders took this offer. So what you would do anyway, so the rights issue, we're issuing more shares at slightly below market rate. We firstly calculate the amount of shares that they're going to buy. So if it's 100% fully subscribed, you would divide the share capital by nominal value. Again, this is the amount of shares we've got. We're saying it's a 1-for-4 rights issue, so we would just divide the amount of shares by 4. That's the amount of shares that are going to be sold. If it's a percentage, just do a percentage of that number. Then we will look at the nominal value. So we'll issue all the shares issued at nominal. So that lowest price will go in share capital, and anything over and above that goes in share premium. So the actual final bit is exactly the same as the standard share issue. But yeah, rights issue can be a good way of raising extra capital. It's another thing a business can do. Dividends. So dividends are paid to shareholders per share. So often in an exam question, you'll be told that. You've got to be careful. You can have an interim dividend halfway through the year. You can have a final dividend at the end of the year. Both of those will be accounted for. But you could also have a proposed dividend. So a proposed dividend is one that we are saying we could offer, but hasn't been agreed. We would not put those in the accounts. That'll be put in there as a way of trying to trick you. And if you do include it, that will lose you a mark. So dividends, you would work out the total amount of dividends that are issued in a year. They have to be included as one line in the statement of changes in equity. That is something they penalised students for before. So you multiply the amount of shares in existence, check the date quite carefully for that. So you work out the shares in existence, as we've done previously, share capital divided by nominal value. But if you've got the opening balance and there's been a rights issue or a bonus issue since, you've got to be very careful how many shares have actually been issued at the point of the dividends being paid. So it might have been before a bonus issue, it might have been after, whatever it might be. Check the dates carefully, like in any accounts question. Then multiply the dividend per share by the amount of shares at that date. That is the amount of dividends that you're paying. Now, if we look at the statement of changes in equity, which is just to the right, so just underneath limited company accounts header. So the statement of change in equity, what we do is we have our opening balances first. Now, depending on the way they want their exam questions to be, it's unlikely you get marks for that, and sometimes they'll even put them in, but you never know. Sometimes they've asked you to learn the headings. So the headings for the statement of change in equity are share capital, share premium, revaluation reserve, and retained earnings. So share capital and share premium, all we would show here is the share issues that we've just discussed. So you would label them, and you have to label it correctly. So if it was a share issue, you would just put share issue, and you'd put the figure that's going to increase in share capital and the figure that's going to increase share premium. If it's bonus issue, make sure you put in brackets when you're taking the money out of share premium. If you put two positive numbers, you're going to lose the mark for taking it out of the reserve, because you're not showing that you know that it's reducing the value of one and increasing another. I mean, there's no cash implication of that bonus issue. Something else to highlight. Sometimes they like a little multiple choice question about that. But bonus issues, there's no cash implications, so that it's just a simple in and out. You have to show that. Rights issue, again, you're showing the increase in share capital and share premium. So those can be a lot of marks to record those share issues. It's one mark quite often for each individual entry, and then additional marks for any calculations linked to those. When it comes to retained earnings is basically retained profit. So we've got profit has got to be one of those figures. Now, in an exam question, and this has happened before, they might ask you to calculate the new profit after they've given you a draft profit, and you've got to make a couple of adjustments to it. That could be worth a couple marks in itself. But the key thing is profit after tax. This is because we cannot pay dividends until we have paid our tax. So we'll put profit after tax, and we'll put that figure in the retained earnings section. Please put it in the right section. Dividends, which we've calculated, and we've shown how to calculate them on the previous question. You'd put those in brackets in the retained earnings section, because it obviously, if you're paying dividends, that reduces the amount of retained profit you've got within the business. Then what we've got is the revaluation reserve. Now, I haven't listed those individually here because that's silly, but I'll look at that as silly. I'll show you that in a moment, the calculations, but we would put revaluation and that would increase the value of the revaluation reserve. Now, like I said, I'll do the calculations in a minute, but on the left-hand side, just have a label saying revaluation and it will go in the revaluation side. Quite often in exam question, it says a total column is not required, and then students don't put the closing balance at the end. The closing balance at the end is a row. That's a total row. The column is on the end. Quite often, if you see a question, it will have one that side, which is always nice for crosscast. They don't want to give you marks for doing it twice. That's why. So please, please, please always do the totals. So the statement of changes in equity can be quite a complex question, or it can be quite a straightforward question. I've seen it with marks from 5 up to 14, so just make sure you know each of the adjustments. It was 2 or 3 years ago they did the 14 marker on it, so there's nothing to say they couldn't do it again. Revaluation reserves. So what we're looking at with the revaluation reserve, so I know I'm skewing across, so top right now, revaluation of non-current assets. What we're saying here is we've got a non-current asset and it's worth a different amount to the book value in our statement of financial position. Now, we've got to be looking at whether there's been a material impact on the value of our non-current assets, and it's also got to be done or completed, with sufficient regularity. So what we're saying here is if we revalue an asset, we can't just do it when it looks good or when the value is likely to have increased. We need to do it on a regular basis to keep that value accurate. And like I say, and if there is a reason to believe that there's been a material impact on it, we need to be revaluing the assets and all of the assets of that type. So if you've got one property that's gone up in value and others you feel they haven't, you can't ignore one of them. You've got to do more. Now, if we have a revaluation, the good thing for that is that our business is worth more money because obviously we've got assets that are worth more, the value of our company goes up. That means that we look obviously more attractive to investors, but also to borrowers. So if we've got a higher value, we've got more that we can use as securities. The asset is worth more, we can use that to secure against a loan. Equally, because equity is going up, so remember equity is the investment in the company, but equity is going up without any borrowing, that means that gearing will fall. So we actually look better in that respect as well because we've got a lower gearing percentage, so we look less of a risk to investors. So that doubled up with the security means that lending in the future may potentially be easier. However, if we've got a higher asset value, that means that the depreciation charge for each year will be higher, so it will lower our profits because we'll be making a lower profit per year, which does mean we'll pay less tax as well. So there is that, but we don't tend to talk too much on the tax side here, but that is true. But lower profitability will clearly deter investors. So what we're doing here, we've got a couple different things to think about. We will increase the cost value of the non-current asset. So that would be the difference between the cost value when we purchased it and the new value. We would also reduce the depreciation because if an asset is higher than its cost value, it clearly hasn't depreciated. So we remove all of the depreciation of the non-current asset. And so then that difference between the net book value and our new valuation is put in the revaluation reserve. So it's like a combination of the reduction of the depreciation and the cost value of the non-current asset. If you want to see that in practice, there's, like I said, the really good question in 2023, which goes through the steps on that. But yeah, you would do that. So the revaluation is another one that's come up a few times, but could come up again. And the implications for a revaluation, both positive and negative, are really important to think about. But businesses should, especially companies, should be revaluing non-current assets to show an accurate value of their assets in the financial statements. Just showed below there, I'm not going to go into it in masses of detail, but it is something to consider, is the schedule of non-current assets. Only come up once, 2019 or 2020, so it's definitely a topic that could come up. The schedule of non-current assets is in the notes sections of a limited company financial statements, and it's trying to show how the non-current asset value has changed over a financial year. So what you're looking at here is marks for each individual step. So if we went through, we would have sections for each individual type of non-current asset. So I put here land and buildings, equipment and fixtures. You'd put your opening balances in, probably already given because they don't want to give you marks for that. Any additions for the year, and obviously it wouldn't necessarily be each category, but it could be, but you'd get marks for the additions. Now, usually you'll be giving that, so you're not going to get many marks for that, so there may not be that many additions. From disposal's point of view, this is the cost value that's been removed from your accounts. So if you've disposed of one of those assets in the financial year, this will be put in brackets. The revaluation would be any difference between cost and the revalued amount. Nothing to do with net book value because the top half is just about cost. So the difference will be put in the relevant category. We would then have a balance brought down or a closing balance for cost. It doesn't always get labeled balance brought down. Depreciation. So again, we look at any changes in the financial year. So the revaluation. Now this is an interesting one because quite often in an AQA question, they'll probably include land because land's not depreciated and then you don't need to juggle around with this. But if it is an asset that has had depreciation, you would have to show it here. So you'd have eliminated on revaluation and you'd put it in brackets. The only question that's ever come up did not have this, but sometimes students include it because they think it should be. But because it was land, it hadn't been depreciated. So you could have eliminated on revaluation, but just carefully check it because there's a good chance it's not going to be there. Eliminated on disposal, likely to be there. That's the amount of depreciation to date on the disposed asset. Now, again, you want to check for that. You might have some calculations to get to that figure. That could be a couple marks. It could be a given the net book value and the cost. It could be a given the amount of years. That could be a reasonable amount of marks, so look out for that. But the biggest marks will be for the charge for the year. The charge for the year, you might have to make adjustments based on the new cost value. You might have to make adjustments on the fact that you've got the eliminated disposals, eliminated on revaluation for the year on the depreciation. There's lots of adjustments. Now, I'm not going to go through all of those now, but if you do get a schedule of non-current assets questions, as much as half of those marks will probably be in the charge for the year. So clear workings and clear methodology on how to get there is really important. Then the last thing is to remember, you have to calculate the net book value at the end. So the new net book value. So the new cost, take away the new depreciation is the new net book value. That in itself, that row is probably going to be an own figure mark as long as you don't put any weird random things in there. So please do remember to do that. To schedule non-current assets, not come out that often. So definitely one to think about. But also it's got so many different bits in there, be it disposals, revaluations, depreciation, that it's going to help in another question if you review it. Statement of cash flows, not generally people's favorite topic to cover. It's come up a few times over the years. Last came up a couple of years ago. So you just don't know. They could definitely look at it in isolation. So a bit like I've said with the schedule of non-current assets, actually understanding the statement of cash flows could be useful for a question even if the statement doesn't come up itself. You do need to learn the big layout, and I've really squeezed the layout onto this A3 sheet, and I've got to move where I am on this video in a minute because I'm hiding part of it from me, which means I can't see it. But different things. So in the middle, underneath the statement of changes in equity, I've just put profit from operations. If you're not given the profit from operations figure, there is a good chance you do not need to do the full layout. But look at the question. If the question says a full layout is not required, then you don't need to do the full layout. If it doesn't say that and it says complete a statement of cash flows under IS7, they want the whole layout. That did come up a couple of years ago and students fell for it. It wasn't necessarily the greatest wording because they did say it needs to include the net cash from operating activities, but that was more highlighting a own figure mark rather than saying don't do the whole layout. So just be careful to carefully read the wording of any question that you answer. Right, statement of cash flows. You start with the profit from operations. That in itself is a little area that could be a question. It could be they give you some figures and they go work out the profit from operations. It's not even statement of cash flows, but it's useful. So what we look at is we go from retained earnings. So we look at the retained earnings at the end of the year. We compare it to the retained earnings at the beginning of the year. So we take away the beginning from the end. That would then give us, if all the other things were equal, the profit we make. But it isn't because there's other adjustments. So we're going to get 1 mark if we use the workings and show our workings if we can get the right answer from illustrating that. We're then going to add back a lot of things that have been taken away from our profit to get to the retained earnings figure. Now, one of those is dividends. So you might have to work out the dividends figure or you're given it. But if you add back dividends from the difference between retained earnings at the end of the beginning, you have actually got your profit after tax figure. So then we add back tax expense. Tax, we'll look at it in a little bit, but if you're being told the tax expense from the income statement, you add it back because obviously that was deducted from profit as well. And then if we know we've got profit after tax, we know if we add back tax, we've got profit before tax. Then we add back finance costs. That then gives us profit from operations. So that's layered. That's quite often 5 marks. And like as you could see how they could easily throw that in as a question to get some marks as well. I've put in there a little note, finance cost. You might have to calculate the finance cost. That could be an own figure. That could be something in a lot of questions. So look at the debenture dates. We pay interest based on when they're issued. So if you're issued a debenture on the 1st of February, the year ends the 31st of December, well, you're going to have that debenture for 11 months of the year. If you've repaid a debenture on the 1st of February, well, you've only got to pay interest for 1 month of the year. Look at the debenture dates quite carefully. That can quite often be a few marks. So definitely something else to consider is finance costs. That can come up anywhere. Once we've got our profit from operations, we then look at our operating activities. We've got 3 sections, to be fair: operating, investing, and financing. And so what you're looking at in the statement of cash flows is how we've generated cash in 3 different ways, and we're categorizing. So if we look at the operations section, we start with that profit from operations, which will clearly be own figure based on what we've done above, or we've given it, and then we probably know we've got to do the full layout. So then we're looking at how much money a company is raising from an operating perspective. So increase or decrease in trade receivables. So basically the SFP figure, if trade receivables is going up, that means we're owed more money, which means we've got less cash, which is why that's in brackets. If it's going down, we're being paid quicker, so we've got more cash, so we'd add that. There's trade payables, the opposite applies. I don't like doing it like that, so we need to think about the logic. So if payables goes up, that means we've not paid as many of our suppliers. That means we've got more cash flow, so we'll add it. If trade payables has gone down, that means we've paid off more of our debt, so we would take it away. Inventory is an asset. If we increase it, that means we bought more inventory, we're holding more inventory, so we've spent more money. So that means that we've got less cash flow. Whereas if inventory has gone down, that means we've used up more inventory in our stock room, we haven't replaced it, so therefore we've got more cash. We've then got depreciation. Depreciation can sometimes be a figure you've got to calculate. It could be with opening and closing net book value of assets. It could be with data. Depreciation is just, you've got to look at all the different ways depreciation could be asked. But you've got to add it back because depreciation is a non-cash expense. The cash impact of a non-current asset is when we purchased it, not on the depreciation charge. Profit and loss and disposal. There's 2 issues with profit, loss and disposal. One is profit or loss, not cash flow. And we're looking at how much cash we've got, not how much profit we make. Understanding the difference between profit and cash is something you really, really need to get as an accounting student. But the profit or loss and disposal, so it's not cash flow, that figure, and it's also an investing activity. When you sell a non-current asset, that's something to do with an investment, so it needs to be put in the right section. Dividends received, again, that's investing. You've invested in another company, so that shouldn't be an operating. This is day-to-day running the company. So we're going to take it away here to put it somewhere else. And we then look at a subheading, which is cash generated from operations. We then have tax paid, not tax expense. Like I said, we'll look at that tax tier count in a moment. And interest paid. So interest paid is likely to be the same as finance costs from above, but if you had an interest payable at the end of the year, so if you had an accrual, that could be a slightly different figure. That could be an extra nuance that they would add into it. That gets us to net cash from operating activities. So that in itself has been an exam question in its own right, because there's lots going on there. After that, we've got investing activities. So I'm looking at how much detail, because I'm going to move my camera in a moment, how much detail I've given you. But investing activities, the key one is the purchase of PPE, which is in brackets, which means that usually the net cash from investing activities is negative, because if we're investing, we're spending money. But a little T account there for a PPE and net book value. That's a good little T account, because sometimes you won't be given the purchase figure, and a little bit of manipulation on that T account will be a good way of getting there. So we've got the opening balance on the debit because it's an asset. The carry down is going to be on the credit because that's the closing balance. And then obviously the closing brought down will be on the debit underneath the totals. So anything that increases the PPE will go on the debit. So that would be revaluation, Obviously, if it's an upwards revaluation, which normally it would be, it doesn't have to be. Additions will be on the debit. The reason I said that with the revaluation is in your questions. I don't think they'll do a downward revaluation, but just keep that in mind. On the credit of the PPE, you're going to have the depreciation because clearly that reduces the value of your non-current assets and disposals at net book value, how much they've gone down. And then you can use that, and then additions would be the balancing figure. That will then give you a purchase of PPE. Proceeds from disposal, you need to be able to differentiate between profit and cash. So if we make a profit on disposal, we add that to the net book value to give us the proceeds. If we made a loss, we take it away. Dividends received, we're just going to put it in here. And then we have our net cash from investing. Like I said, normally in brackets, doesn't have to be, but it normally would be. Financing activities. So the next section is all about how we raise money as a company. And I just want to say again, you could have an individual section of these. It doesn't have to be operating. They could ask you to do the investing. They could ask you to do the financing. And then that varies the amount of marks they could actually apply to this question. Financing, proceeds from a share issue. Carefully look at that, because you need to look at the difference between share capital and with share premium between the 2 years. If share premium has gone down by the same amount, share capital's gone up, well, that's a bonus issue as we just looked at before. But either way, a share issue, the amount of cash we receive will be more because usually we sell it at a premium. So we look at those proceeds or repayment of a loan, debentures, look at how much they've changed. If they've gone down, that means we've got a cash outflow, we paid them off. If they've gone up, got a cash inflow. Dividends paid, not proposed. We've talked about that earlier, but the amount of dividends we paid will take away here. That is a financing activity. So then we have the net cash flow from financing activities. We add the three together. That's the increase or decrease in cash equivalents, if I could say it. So the three sections, that's exactly how much cash we've generated in the year. We add that to the opening cash and cash equivalents balance. Look, you might have a cash balance, you might have an overdrawn balance, you've got to add them together. Or just look, you might have an overdrawn balance, you're missing it, so that's got to be in brackets. That gets added to the net change. That gives you the closing balance. The only other thing to add, you've got the tax T account in the corner. That could be a question in its own right. So the opening balance is the liability. How much did we owe in tax at the beginning of the year? So it's going to go on the credit. The tax expense for the year has to go on the credit because that is the figure in our income statement. That's how much money we think we are going to owe. We keep saying think because it is a guess. Tax liability at the end of the year is a guess. We adjust. We discuss that with the HMRC over the next year with our allowances. You don't go any further than that at A level, but you do need to appreciate that that is an estimate. So then the carried down at the end of the year will be on the debit, with the brought down will be underneath the totals on the credit. The amount paid, the bank figure has to be on the debit of tax because it's going to be the credit in the bank account because it's money out of the bank account. So tax T account, another good one to learn. It's a long video. It's covering a lot of stuff which will be really useful for limited company accounts. So hopefully it's useful.